It happens every week or month like clockwork. Your paycheck hits your account. You see that number on the screen, and you feel a sense of security. You think your money is safe, sitting in a digital vault, waiting for you to spend it. But here is the uncomfortable truth. That number on your screen? It's mostly an illusion. Your money isn't sitting in a vault. The second you deposit it, it's gone. It's out the door, working harder than you ever did to earn it, just not for you. The biggest banks in the world hold trillions of dollars in assets. Yet, they offer you free checking accounts and pay you virtually zero interest on your savings. How do they build those skyscrapers and pay gigantic bonuses if they are just holding your cash for free? Today, we are pulling back the curtain on the banking system. We're going to show you how your deposit becomes their profit, the hidden fees that bleed you dry, and the high-stakes gambling they do with money that technically belongs to you. Let's follow the money. The great magicians. Fractional reserve banking. To understand how banks get rich, you have to understand that they are not storage facilities. They are magicians. Their greatest trick is something called fractional reserve banking. Here's the simple version. When you deposit $1,000, the bank doesn't keep $1,000 waiting for you. Regulators might require them to keep, say, 10% or $100 in reserve. And what happens to the other $900? They lend it out immediately. This is the magic trick. John thinks he has $1,000. Sally has $900 of that same money to buy a car. The bank has essentially created money out of thin air. This is the multiplier effect. Your single deposit ripples through the economy, allowing banks to create countless loans, all based on the initial cash you provided. They aren't lending their money, they are leveraging yours. The spread, net interest margin. So, they lend your money out. That's the mechanism. But how does that generate profit? This brings us to the core of the traditional banking business model. The spread, technically known as the net interest margin. Think of the bank as a middleman. They rent money from depositors like you, and they lease it to borrowers. Right now, if you put your money in a standard savings account at a big bank, they might pay you a pathetic 0.4% interest per year. That's what it costs them to rent your cash. But when they turn around and lend that same money to someone for a credit card, they charge 18%, 24%, sometimes even 30% interest. That massive gap between what they pay you and what they charge borrowers is the spread. They take your money, pay you pennies, and lend it out for dollars. It is the oldest, most reliable money-making machine in history. And when the central bank, like the Federal Reserve, raises interest rates, banks often raise the rates they charge for loans much faster than they raise the rates they pay on savings. The spread gets wider, and they get richer. Death by 1,000 cuts. Non-interest income. But wait, there's more. The spread is how they make money when things go right. But banks have figured out a brilliant way to make billions even when things go wrong for you. This is the fee economy. It's death by 1,000 cuts. These aren't just administrative costs. They are massive profit centers designed to punish the people who can least afford it. Let's talk about the villain of the story, the overdraft fee. You buy a $5 coffee, but you're $1 short. Instead of declining the card, the bank covers you and charges you $35 for the privilege. In the US alone, banks generate billions of dollars annually just from overdraft fees. It is a tax on being poor, or just momentarily disorganized. They charge you if you don't have enough money. They charge you to move your money. Sometimes, they even charge you a maintenance fee, just for the honor of letting them hold your money to lend to others. The casino, trading and investment banking. If you thought fees and loans were the whole story, buckle up. Because for the massive too-big-to-fail banks, the real money isn't on Main Street. It's on Wall Street. Many large banks have two sides. The commercial side, which takes your deposits, and the investment banking side, which acts like a high-stakes casino. Historically, there were laws separating these two, so banks couldn't gamble with grandma's savings. Those laws were largely eroded over time. Banks have massive trading desks. They trade currencies, commodities, stocks, and incredibly complex financial derivatives. They use their own vast reserves of capital largely built on the foundation of depositors' funds, to make bets that can generate billions in a single quarter. They also advise giant corporations on buying other giant corporations, taking huge fees for facilitating the deals. This is money making money at a scale that is almost unfathomable to the average depositor. Finally, in the modern era, every time you swipe your card, the bank gets a cut. It's called an interchange fee, usually 1% to 3% of the transaction, paid by the merchant. That's why they offer you those cashback rewards. They want you swiping. So, how do banks make money with your cash? By leveraging it, lending it, taxing it with fees, and trading with the capital it creates. Banks aren't public utilities. They are businesses designed to maximize profit. Knowing this doesn't mean you shouldn't use banks, but it means you should stop looking at them as benevolent guardians of your wealth. They are using your money to get rich. The least you can do is minimize their fees, shop for better rates, and understand the game you are playing. Now it's time to hit that like button. Make sure to subscribe and hit the bell icon so you don't miss our next video. Thanks for watching us.